While in March, as the pandemic hit countries around the world, we saw a very sharp sell-off in markets. And that sell-off in markets did uncover some of the weaknesses in the financial system. So, for example, money markets dried up, and that is certainly an area to look into. But also treasury markets saw a dash for cash, where liquidity in treasury markets was surprisingly weak. So there's certainly a number of areas to look at once this crisis is over.
Yeah, and we must circle back, I think, to emerging markets at this point. How vulnerable are some of these emerging markets, particularly where the government's running high levels of borrowing?
Yeah, we see differentiation across emerging markets. So some emerging markets have no difficulty in terms of accessing market finance. In fact, investment grade rated emerging markets have easier financial conditions, so have lower funding costs today than they had at the beginning of the year before the crisis hit. But at the same time, as you point out, there are some weak players that have questions around the sustainability of their fiscal position, and they do have high funding costs. So we see this very sharp differentiation, and we expect some emerging markets to come out very strong of the crisis, but there are certainly some countries that are weaker.
And Tobias, just throwing forward here, we obviously are going to have to pay for all of this at some point. Future generations will have to pay for it. As you look at the routes forward, are we talking about inflation to inflate away the debt, stagflation if we don't have a solid recovery, or even some program that would allow, cancellation of debt? Is that on the cards? What's the most likely route through this?
Yeah, so we don't see inflation at the moment. In fact, we forecast that output gaps are going to be large in coming years. So output gaps mean that demand is lower than potential supply. So this has deflationary pressures, if anything. So that allows monetary policy to be accommodative, and hence interest rates are expected to be low. So even though debts are higher, interest rates are lower, and so debt service burdens are not necessarily higher. It really depends on what country you're looking at here. So we don't expect inflation to play a big role, and we do expect central banks to tighten monetary policy if inflation comes back at some point in the future. So we're not so worried about that. We are worried about the fiscal position in some countries. So while the strong players can pay back their sovereign debt, some weaker players will struggle. And indeed, this year we have seen some market solutions to debt restructuring, and that could happen to a fairly small number of countries going forward. International financial institutions such as the IMF and the World Bank also help the particularly vulnerable countries in the world. And together with the G20, there's a debt service suspension initiative that has been successful so far.